Friends, in this video for ithought Advisor, I am going to talk to you on the topic from an advisor's perspective. An advisor is a very important position. It is a place where we handle a lot of trust, and it is a place where we function with great responsibility. When markets go up, an advisor's responsibility goes up. When markets go up a lot, like you're seeing now, that becomes even bigger. So the advisor's responsibility is something that needs to be carried through in a careful way, in a way which protects investors, guides them towards the future, and still ensures that their participation in the investment process is active and progressive. Everybody wants a good advisor. Everybody wants an advisor who delivers. Everybody wants an advisor who is futuristic. An advisor also would love to work with people who understand what it takes to be futuristic, what can deliver with a futuristic advisor, and how to function seamlessly and smoothly with a progressive advisor. The reasons are simple. When you have elevated markets like now, everything looks expensive because the headline numbers in the stock market, the indices, the most popular companies are all trading at valuations which we obviously know are not cheap. So from an advisor's perspective, the first priority is to ensure that investors own portfolios which don't get impacted by very expensive stocks, because when the market falls, expensive stocks will fall too. And when the markets go through a transformation from one cycle to another, expensive stocks will fall even more. We have seen that in every cycle, right? And it will happen again. So the advisor needs to keep his clients away from that universe of super expensive stocks. But where do you invest the money? When you say that you will not invest in super expensive stocks, immediately people think that you are going to invest in stocks which are not of high quality. That binary approach is not true. There are a number of companies which are not super expensive right now, which can become more valuable and more sought after 2 or 3 years. Sectors go through their own cycles. Some sectors remain out of favor for years together, and then when economic development takes a different trajectory, when it assumes a different pattern of growth, then those sectors which are down tend to come back in favor. So an advisor has the option of channeling his clients towards thinking differently, towards moving towards these spaces which remain unoccupied even in a bull market, because in a bull market everybody is looking at the most popular parts of the market and they are not looking at the unpopular or the unseen parts of the market. So those dark corners can give us a number of companies which can break away and form a different trajectory of growth and take a different valuation approach. Markets always give us these opportunities, and as an advisor, I believe that we need to be early in those opportunities and we need to stay in them long enough. The second part of my last sentence is very important. We need to stay in them long enough. When we build teams or when we build portfolios aligned to themes, we build investments which perform over narrow periods of time. In fact, for long periods of time, they may not perform. But when they perform, they really reward you for waiting. And that essentially is what I believe is a safer approach to take than to just chase what is popular. So the road less traveled or the path less frequented is definitely a safer way for an advisor to take his clients along. The investment journey will be much safer. The investment choices will be very different. The investment valuations will be in favor. And while the markets will go through their air pockets when there is a correction, these parts will fall and quickly rise again. So we saw that in the last uh, crash of 2020, where pharmaceutical stocks, which we believed was safer to own, went through a sharp correction and then went back, and you know how they came back, right? Similarly, we saw the trend in many thematic opportunities, and we will see the trend again in this cycle too. So, as an advisor, choosing what is not popular, what people are not looking at the moment is most important. Building investment positions in those parts of the market which are not popular now is a good idea, and building them carefully and clinically is paramount. What do I mean by this? I mean that you should first start a small position in that theme and then keep watching. If the market's correct, then you get more conviction in those themes, and once you get more conviction in those themes, you scale them up. While these themes may also correct a bit when the market corrects, you will get a limited window of time to buy more in those themes. It's not going to be a long runway after a market corrects. So, while markets can correct, advisors must prepare much before that by beginning new themes which they would like to scale up during a correction. Most people think that let the markets correct and then I will do what I need to do. My experience is such investors never participate in the markets and they come back after the markets have gone up again. Unless you go through that phase of pain with very modest positions in new themes, you are never going to participate with positions which are of significant size to give you overall portfolio returns. So you go down a bit and then you come back with a bigger position, right? It's like diving in and coming back with a booty. That's what I believe an advisor should help his clients do in times like this. Importantly, an advisor should also help his clients get out of parts of the market which are extremely risky and where, if there is a correction, those parts of the market may not come back with the same force as they did probably in 2020. So that is the second responsibility. So I have spoken about two responsibilities. One, where you go to the road less traveled and pick up thematic choices and investment opportunities which no one is looking at. The second is you walk investors out of teams which have performed like crazy and will probably not be able to catch up with their own performance in the near future. So once you have done these two things, then an investor's portfolio is kind of ring fenced, it's bulletproofed, it's better positioned to face any market adversity. I don't know when there will be a market adversity, but I know for a fact that that preparation has to start now, and one needs to ideate new themes for the future. One needs to move forward into the future. While portfolio also needs to be moved gradually forward into the future. You may ask, what about my existing investment? Should I sell everything in one day? I think not. Sell the most expensive parts first, and then gradually, as each theme matures and gets fully discovered by the market, move your money to safety so that when the market corrects and when your futuristic ideas become cheaper, you will be able to scale them up into a significant part of your future portfolio. So that in essence is my perspective as an advisor, and that is a perspective which I wish to share with you so that we are all on the same page. Our colleagues and all of you come together to create a new portfolio and also walk the existing investments to safety when they become mature. The good news is we have several themes which are still having a longer runway towards maturity, so there is no urgency to sell existing investments, but there is an urgency to start newer investments. We have at least 3 or 4 themes which we want to start, and with your full cooperation and participation, we will be able to start them one by one. And we would love to do that in good time so that when they become more attractive, we can buy more and we can build much bigger positions for the future. Having a greater opportunity is important, but preparing for that greater opportunity is even more important. Thank you for all your support. Thank you for watching this video. I do hope all of us act on what we have discussed in this video. Thank you very much.